So how should ETF investors position now? Joining us now is David Schassler, head of multi-asset solutions at Van Eck, along with Todd Rosenbluth, head of research at VettaFi. Gentlemen, thank you so much for joining us.
Thank you.
All right, why don't we start with the
Great
big
to be
picture?
here.
David, great to have you here. We're going to start with the big picture. We're essentially in another 90-day pause. So what should an investor do, if anything, when it comes to domestic investing?
Investors, first off, we're sitting 5% off all-time highs in the S&P 500. If you didn't like the experience you had in April and you didn't like your drawdown experience, you got a gift from the market gods to diversify. We want to see people diversify. We want to see people diversify internationally. We want to see people diversify really into real assets as well, specifically gold. And if you're into it, I also want to see you diversify into Bitcoin. So the game plan right now, run a diversified asset allocation, diversified internationally across asset segments, across markets. That's our best thoughts on that.
David, you got us drinking out of a fire hose. We're going to get to all those topics in just a minute, but I just want to focus just on the equity markets for a second. When you say diversify, do you mean like an S&P equal weight ETF, or you're saying other sectors? You should move out of things like tech and financials that have really caught a bid so far this year.
If your portfolio is predominantly invested in the United States, we want to see you diversify into international markets as well as emerging markets. Right now, the markets are priced richly, meaning recessionary risks are high. We're not calling a recession, but we're saying recessionary risks are high. With PEs where they are in U.S. equities, there's a lot of value overseas. Secondarily, from a catalyst perspective, we're looking at a world that's more bifurcated. We're looking at a world that's going to be less reliant on U.S. dominance. In that type of setup, these countries are going to be forced to move forward, pushing their own growth. And when you have that backdrop, valuation support with a catalyst for growth, we think it's a good time to diversify some of your U.S. exposure internationally.
All right. Todd, really quick, want to get your thought on today's rally. We're seeing the markets boom on the idea of this temporary tariff reduction.
Yeah, we've seen growth equities rebound much more strongly. Those more technology-oriented, consumer discretionary-oriented sectors. So the S&P 500 growth strategy is outperforming the S&P 500 value. We think a good way to split the middle is to take a quality but with a growth tilt. So VFLO from Victory Shares is one of those ETFs we've been talking about at VettaFi. It's a value-oriented strategy but has a growth filter to it, because we might not see this rally continue on the growth side. So you want to make sure you have balance within your portfolio.
Yeah, it sounds like you're talking about one of those factor ETFs. Seeing a lot of people pour into those this year looking for outperformance. David, you were talking about it, but prior to today's news, there was a lot of buzz in the ETF world about international investing. Todd, I'm going to come back to you. VettaFi, just a few days ago, you're citing that one of the year's most popular equity funds was the Vanguard Total International Stock ETF, the ticker's VXUS. Net gains of about $5.5 billion. However, that same article also pointed out that equates to just under a tenth of the asset influx into Vanguard's S&P ETF, the VOO. So is international now back on the sidelines in your opinion, Todd? We know what David thinks. He thinks you need to look for international for opportunities. But what about you, Todd? How are you seeing it?
Well, the flows have certainly been favoring U.S. equities. Investors have been buying the dip, and today they're being rewarded. And you're right, Vanguard 500 is approaching $60 billion in net inflows just this year. That could blow away the record that it set just a year beforehand. But we are seeing investors start to embrace international strategies. You mentioned VXUS being one of those more popular ones. There are the benefits of diversification. We haven't fully seen it, but I think this trade deal or this pause could help to inspire people to diversify outside the United States.
All right. So, David, while we're talking about diversifying away from the United States, what about China specifically now? Obviously, the other side of these trade talks in Switzerland over the weekend, and also the tariff rate for goods going into China also lowered.
I think there's only one way to really perceive what happened, and that's as a positive. So another cloud removed, but the fact of the matter remains that there's a ton of uncertainty out there. So when you think about all the uncertainty out there and you start to think about markets like China, which is stimulating and they're stimulating aggressively, you start to think about places like India, which is one of the best growth stories we think out there, maybe China 20 years ago. You start to look at some of these emerging markets and there's a lot of things that look interesting there. So having exposure to China makes sense. Having exposure to India makes sense. We're also not anti-United States. We're just saying that if you're predominantly invested in the United States, you probably want to diversify outside as well.
Todd, your thoughts on China?
Yeah, we've seen strong interest in China ETFs in the beginning of the year that faded. KWEB is the Crane Shares China Internet ETF. It's still the largest of those China-focused ETFs, the more growth-oriented companies. Those are less likely to be negatively impacted by whatever happens from tariffs because it's a China-only story as opposed to diversification and multinational, the way that some of the other Chinese companies are. KWEB is one of those ETFs worth taking a closer look at in this environment.
All right, David, I want to come back over to you. You mentioned India just a short time ago. You previously talked about India being one of the most compelling structural growth stories in the market, also noting the recent India correction as a buying opportunity. One ETF that we track here at CNBC is the INDA. I'm looking at it pretty much flat year to date, up about 1.5%, but really mostly moving sideways throughout the year. Is that the way you would play India right now, or are there some other ETFs you would look at?
Yeah, so we don't. First off, I guess big picture, just on the India structural growth story. You've got huge population, tech savvy, well educated, and you've got a government supporting that. So we think everything lines up there for the growth story. And that correction is exactly a buying opportunity. So that's generally where we think about it from a structural perspective. We offer a couple different ETFs. DGIN is one of them. So I'll throw that one out to you.
All right, so we're actually looking at some of them right now. The Indian ETFs, or the ETFs that track Indian equities, definitely moving up higher right now. Looking at a number of them right now, the one you mentioned, DGIN, up over 5%. All right, David, I know you're excited. We're going to move on to gold now. You've been talking about this a bit. One of the major hedges amid the recent uncertainty, actually taking a leg lower today. Gold down more than 3%. But again, Todd, how much of a hedge is appropriate right now? How do you view it?
Yeah, we've seen advisors increasingly look to commodities like gold to be a diversifier within a broadly diversified portfolio. ETFs like GLD, GLDM give you pure exposure to gold. And then there's some gold mining ETFs. I'm sure David's going to talk about the VanEck ones in a moment. So I'll just highlight GBUG, which is a Sprott ETF, which is actively managed in the gold mining space that is relatively new entrant into the market, but is a compelling one. But VanEck has some great gold mining ETFs as well.
So David, even with the recent run before today's pullback, again, gold is safe haven, investors kind of moving away from that safe haven into the equity market, you thought there was still a lot of room and time for investors to add gold. I want to ask you, how are you viewing gold right now? I'm looking at gold right now, trading at about 3,200. Do you have what's your price target? And do you think it's still a good place to put money in this current environment?
I couldn't imagine a better backdrop for gold. So you've got a situation where huge debt, huge spending, political chaos, all the stars are aligning for the macro thesis on gold. Here's the thing with gold. The gold market's a lot smaller than that of the equity market and a lot smaller than that of fixed income market. And you've got gold now significantly outperforming stocks over the 1 year, the 2 year, the 3 year, the 4 year, and we think eventually the 5 year. That much outperformance makes it so that gold can't be ignored. And you've seen central bank buying for an extended period of time. Now you're seeing the return of the Western investor into gold, and that's the gold flows that Todd was just referencing. That backdrop sets us up, we think, for a leg higher in gold. We've got the price target on gold at $5,000. We think it hits there probably somewhere in 2026, simply because you've got a stable asset base, you've got a stable supply. And then all these flows we think are going to translate to higher gold prices.
All right, David, then on the flip side, VanEck, one of the first movers into what a lot of people call digital gold. Of course, we're talking about Bitcoin. It was also lower today, but hasn't always been really trading right in line with gold. Your thoughts on allocations for investors right now?
Bitcoin is the risky cousin of gold. We like it for all the same reasons. It's just a lot more volatile. So for us, it's not either or, it's both of them. Thinking about solutions specifically, we talked about gold before. Ounce, OUNZ, is our gold bullion ETF. And we've got a diversified real asset solution, which has all real assets in it. That's RAX, RAAX. That's the VanEck Real Asset Fund. But on the digital asset side, we have HODL, HODL. So lots of different ways to play it. But it's from our perspective, it's both, not either or. And we think both of them do great in the years to come.
So Todd, you and I, we've actually talked quite a bit about Bitcoin. Last week, the IBIT Bitcoin ETF saw some of the top inflows. We're also seeing a lot of ETF innovation around mixing Bitcoin with other strategies. And now we're seeing some progress around Ether. Where do you see this all headed next?
Well, you're right. IBIT, again, was very popular. It's the largest of those Bitcoin-oriented ETFs. I want to piggyback on what David just said about the riskier cousin. And I'm impressed with what's going on in the options-based world tied to ETFs. So Calamos has continued to roll out a suite of options-based downside protection ETFs to give you exposure to cryptocurrency, to Bitcoin, but limit that downside, either 100% protected, 90% protected, 80% protected. Calamos has an interesting lineup for people who want to have some exposure to Bitcoin, but not necessarily that same level of volatility.
All right, David and Todd, thank you so much for your time, your insight. What a great conversation. That's going to do it for this week's ETF Edge. Remember, you can catch this and all of our previous shows at www.cnbc.com/ETF Edge. Thank you so much for watching. Have a great day.